Hi there. Let's talk about appraisals. So, what are they? So, appraisals are how the bank who's going to lend the money for the home sends their eyes out to the property to make sure that the bank is making a good investment. So, when a mortgage is written for a property, the mortgagee, the mortgagor has no idea what this property looks like. They don't know if it truly does have 3 bedrooms and 2 baths. They don't know if there is water leaking in the basement. They have no idea if the appliances are even still in the home. So an appraiser is a third party that is hired by the mortgage company, by the lender, by the bank, to go out and assess the property. They will put a value on it. And depending on the loan type, there will be a list of contingencies, not exactly contingencies, but a checklist that the appraiser is going to be using to complete the form that the bank has provided to indicate what condition the property is in. Is there any peeling, chipping paint in the case of an FHA loan? There are some items that are important to the mortgage company. The reason why is because the mortgage company is going to be reselling this loan. So mortgage companies usually are in the business of creating mortgages, not keeping and servicing mortgages. Now, there are some mortgage companies that do that, and there are local banks who do that, and credit unions who service their own mortgages. But if you have had a mortgage and realized that your mortgage has gotten sold to a new servicer, that's because that's the most common way mortgage companies handle their mortgages. They don't usually keep them in-house. Instead, they will sell them, they'll bundle them, they'll put a whole bunch of them together. They may put, 200 FHA mortgages together and then resell them on the open market. One of the largest buyers of those security-backed mortgages is the National Education Association. That is where a lot of teachers' 401k money is invested, is in housing. It's safe, it's secure, it's relatively stable. Certainly we have our ups and downs, but I would argue the real estate industry and market does not have as many ups and downs as the stock market. It is a more conservative investment. So all of those mortgages get bundled up and resold on the secondary market. And because they have to be bundled and because they have to be resold, they all have to be identical. So there are standards for each one of the properties depending on the loan product that's being used. So if a buyer has applied for an FHA mortgage and they have found a property they would like to have, they've gone under contract on it, the lender, the originator, the loan originator, gets a copy of the contract and sends out an appraiser. Now, back in the day, that was where the lender would call up the appraiser and say, "Hey, Stephanie, will you go out and appraise this property for me?" Well, after the real estate market crash, some of the regulations that came down were that the lender and the appraiser should not be allowed to speak to each other. Okay. So now the lender goes to a portal, and it's a portal run by a third party, and it houses the appraisers. And that third party vendor will assign the appraisal to the appraiser in a random assignment. Now, the control the lender has over it is the lender gets to choose who is in that pool of approved appraisers. So the lender gets to choose the appraisers, but they do not get to choose which appraiser gets which property. Okay. So the lender is going to send the appraiser out through this third party. The appraiser will come out, and typically the appraisal is happening a few weeks into the transaction. Now, once the appraiser has gone out to the property, the appraiser has 10 days to complete their appraisal process and turn in their results. Now, sometimes what they're turning in is an incomplete appraisal. They may be turning in something that says, "Unfortunately, the gas was turned off and I couldn't verify that the gas range worked or that the furnace worked." So that's what's going to call for a reinspect fee. And the poor buyer is going to have to pay an additional $100 or $150 to have the appraiser come back out in order to be able to complete their appraisal. Now, this not only creates a delay in the process and may push closing, and it definitely is going to get everybody upset, but it can also cost extra money to the buyer. So the buyer is already paying $350, $500 for an appraisal, and now there's going to be an additional $150. And the buyer's agent is going to feel frustrated that their buyer is having to pay this additional expense when the seller didn't turn the gas on. So our standard contract, our purchase agreement, calls for the seller to keep all utilities on and serviced throughout the transaction so that the buyer may have their inspections and their appraisal done effectively. So it is not going to hurt, as the buyer's agent, for you to give a heads up to the listing agent. Hey, listing agent, just wanted to make sure that all the utilities are still going to be on and the gas is still going to be turned on and the propane tank is still going to have gas in it in order for us to test that gas log fireplace. Many times I have had a response, oh, no, I just found out that they never used that gas log fireplace, so they have had the gas turned off. Well, that seller needs to have the gas turned back on. And by me just sending a quick reminder, and I'm going to tell you, as the listing agent, I'd be happy to get that reminder just to ask my seller, hey, seller, the gas is on, right? The utilities are on, correct? Now, obviously, if they're living in the home, you're going to make the assumption that all the utilities are still on. But gas is one of those that maybe they're using it, maybe they're not. You know, if it's only running to the gas log or it's only running to the gas grill on the back deck, they may not actually have the gas turned on. So that is going to be something you want to get ahead of, or it's going to cost the buyer an additional $150 for a reinspect fee. Once the appraiser goes out, the appraiser has different criteria that the house must meet depending on the loan product. So if they're going out for an FHA inspection, and I will go ahead and tell you that the conventional loan criteria for the appraisal is less stringent than the FHA, USDA, VA, or VHDA. The purpose of that is because the opinion of the lender is that the loan products that are FHA, VA, VHDA, USDA, they require a smaller down payment. That's the allure, that's the dangling carrot of those products, is that the purchaser does not need to have 15, 20% down payment saved up in order to get into a home, to get into a mortgage product. Well, because of that, you can then understand that the buyer has less skin in the game in this mortgage. So if a homeowner purchases a home with FHA and they're only required to have a 3% down payment and they're buying a $100,000 house, they're going to have $3,000 tied up in that house. Okay. So if they get into dire straits with their finances, they may go ahead and just let themselves be foreclosed on because they really only have $3,000 tied up in this house. Whereas if a person was purchasing that home with a conventional loan and they have 20% down, they're going to have a much larger chunk of their own money invested in this property. So they may be less likely to allow a foreclosure to take over their home. They may work more creatively to try to retain their home and call the retention department of their mortgage company and say, I'm in trouble. What resources do you have available to me? Whereas if they only have $2,000, $3,000 tied up in this house, they might say, just take it. I'm going to move back in with my folks, or I'm going to, live with a friend. So because of that, there's more exposure to the mortgage company. That mortgage is at higher risk of going back to the bank, becoming a foreclosure. So because of that, the mortgage company is going to have a more stringent list of criteria for the appraiser to address when they go out to appraise that property, because the mortgage company knows there's a higher likelihood we're going to end up getting this property back. So we really need to make sure that this property is saleable again, that this property really is worth what the buyer is willing to pay. So the appraiser is going to make sure there is no peeling, chipping paint. If there is peeling, chipping paint, that's going to need to be addressed prior to closing. They're going to make sure there are handrails going down the basement stairs They're going to make sure there is a railing. If there's a deck or a porch that is more than X inches off the ground, it's like 18 inches or 16 inches. Same with handrails. They're going to have a list of criteria that that home must meet. Now let's talk about what happens when they notate that something doesn't meet the criteria. So the buyer is not going to be able to get their loan unless that is corrected. Well, our standard purchase agreement addresses that in clause 13, which is the financing section. The second paragraph, the paragraph following the one where we say how many days they have to apply for the loan and what date they have to have loan approval by. The paragraph right below that specifically addresses appraisal required repairs or lender required repairs. And what it states is that the seller, well, the buyer has a right to ask for the appraisal required repair to be made. Perhaps that's a handrail down the basement stairs. But the seller does not have to address the repair. But the seller cannot keep the buyer from doing it at their cost prior to closing. So the seller will have no say about the buyer hiring a contractor to come over and put a handrail in. Now, I always caution my buyers, you may be improving a property that ultimately you can't buy. What if the loan falls through? So please know that you're making this decision eyes wide open, that you are improving a property you don't own. But typically these fixes are not extraordinarily expensive. You know, typically it's $50 to put a handrail in going down the basement stairs, or $120 to hire a painter to come over and scrape and repaint the 3 windows that have degraded. So usually the buyer, in the spirit of trying to get their loan, is willing to do that. And usually I've found the seller is willing to help. A lot of times what can happen, if it's something simple like the handrail is missing or there's peeling, chipping paint, oftentimes the seller and the buyer through their realtors can agree to let the buyer come over and do it. Maybe it's a vacant house and listen, I have peeled and scraped and repainted. I have removed a diving board from a pool. I'm not recommending you do those things, but it's got to get done. And certainly if you are about to tackle an appraisal required repair, even if you have everyone's permission, call me first, because you know I'm going to have some best business practice ideas for you on how to minimize the liability on your part if you accidentally crack the stucco when you're trying to install a handrail. I'm almost always going to tell you, if you're willing to do it, great, then be willing to pay someone to go do it. Okay. If you're trying to hold the transaction together and you can do it yourself for $30, or you can hire somebody to do it for $50, I'm going to tell you that that $20 is absolutely worth avoiding risk on your part or putting yourself at the risk of creating an issue. Okay. So call me if you're getting ready to do appraisal required repairs on behalf of your buyer. So let's talk about what happens, unless anyone has questions about that, about what happens when the appraisal value comes in low. So this can be a major problem. Miki's got a quick question that I'd love to address. She's asking, do you still have to have a licensed contractor to do such small repairs? The contract says yes, unless all parties agree otherwise. So certainly if the seller and the buyer say, if the buyer says, seller, I'm fine with you installing that handrail and I appreciate you doing it, then sign an amendment stating that the seller has been given permission to install a handrail going down the basement stairs at the seller's expense, and then everything is fine. Always, it's unless all parties agree. The seller can't opt to do it themselves unless the buyer agrees to allow the seller to do it. I don't want a seller doing my electrical work, okay? No offense, unless they're an electrician, I'm not okay with that. But you can agree to do minor repairs like gutter downspouts or peeling, chipping paint. I don't care who scrapes and repaints. I'm perfectly fine with the seller doing that. Now, keep in mind, you have to pick up all those paint chips. So you got to put a tarp down, and there cannot be any chipped paint on the ground. Okay. The appraiser will write that up, and you will be back over there with a shop vac, and you'll be paying a second reinspect fee. So call us. Jennifer had to do that. Jennifer, jump in. Tell that story, please.
Guys, you would think painting would be a simple thing that a seller can do. Yeah. You have to make sure that they know if you're doing that, they have to know about the chipping paint. It cannot be on the ground. And in my situation, the seller had permission to do it. And I was very specific about that. And when I went to check on it, him and his wife were in an argument, and he had gotten a leaf blower. He said, oh, we don't have any chippy paint. And I start looking, and he had taken his leaf blower and had blown all the chippy paint out into the yard like nobody would see it. My husband and my son, they left. They were done.
You mean the seller?
The seller was done. He's like,
seller's left.
They can just take it like it is, or they're not buying the house. And I'm like, that's not it. It's the appraisal. And this buyer has put in all this time and money. We are fixing this. So my husband and my son and myself took a shop vac, and we got up all of that chippy paint and finished painting. So be very specific and be very careful, because something as small and as easy as painting is not always small and easy to every person. What is very common sense, and I hate to say it that way, not everybody's got that, because it was a mess. It was an absolute mess.
And I can only guess that it comes down to, if the paint is peeling and chipping, it is likely older than 1978, and it could have lead-based paint in it. Correct. Which we do not want on the ground. So I can only assume that is the thought process behind not having the chipped paint all over the ground. Okay.
Miki,
so yes.
The sink, that's going to be a little trickier. It's going to be whether or not that buyer, again, is going to say yes or no to that. I've had sellers fix the plungers.
Jennifer, will you share what her question was?
The question is, how about sink leaks? So they can be a little bit more involved, and a buyer may not want a seller to do that just because it's plumbing. Again, like the little sink stoppers, things like that, tightening a toilet. Those are things that some of my sellers have done, never fixing a whole leak like that. But I mean, if they agree, right?
Yep, absolutely. If they agree, that's fine, but it's got to work, you know? I mean, what you don't want is 2 reinspect fees for the appraiser, right? The appraiser doesn't want that either, but they should be paid for coming back out again. You know, I mean, they shouldn't be running back and forth to a house for free. I get it from all sides. It just requires us to be a little more organized and a little more in the loop with each other.
And I will say, the appraisers normally will try to work with you. My friend literally this past week went to a house in Manita 3 times. 3 times because, oh yes, everything's done. Everything's done. Everything's done. Everything was not done. And she had to go 3 times. So imagine what that bill was.
Yes. And they're not trying to be jerks about a reinspect fee, but they got to drive to Manita 3 times, you know, from Roanoke or vice versa. And that is time they're not working on another appraisal that they could be being paid for. So I get it. So it's up to all of us to be more organized and make sure we know if we're truly ready or not. Again, I'm not in the business of wanting to be able to pat myself on the back or for knowing that I am more efficient than the other agent. I want success. So even though I know that other agent should have made sure the gas is turned back on, I am probably going to send an email the day before that says, hey, just wanted to remind you that we've got the follow-up appraisal tomorrow. Do you mind confirming that the gas is back on? Now, I may irritate them, but they may also have a, oh, nuts moment and try and might fire back and go, I completely flaked on that. I'm so sorry. I'm okay with that because mistakes happen. but I still have time to notify through the lender, the appraiser, not to come out tomorrow. Okay. And save that reinspect fee. So it doesn't do me a lot of good to be like, way to go, Ashley. You're smarter than that other agent. I want everything to work right. So I don't have any problem reminding the other agent, and I have no problem with them reminding me of things. Okay.
And keep in mind too, one thing for me was the utilities were on, but my folks were going out of town for a week and it was a vacant house. And they turned the water off at the main because they didn't want to have a leak and them not be here to catch it. So mine was home inspection, not appraisal, but they showed up and there was no water to the house. And I'm like, what's going on? The water's on. But they had turned the main off and failed to let me know that they turned the main off because they were going out of town. So, I mean,
and do not turn that on. I have gotten the phone calls from agents in an absolute panic because they decided, or their client decided, to turn the water on. And now there are leaks everywhere in a house that does not belong to you. That is a true story. Do not turn gas on. Do not turn water on. I hate that you have to come back. And even though you know how to turn water on, don't do it. I know how to turn water on. I know how to light pilot lights. I know how to, flip breakers in an electrical panel box. Should I? Absolutely not. Okay. That is no good deed goes unpunished. Something's going to happen on your watch. I'm just telling you. So don't do it. Okay. Let's talk about what happens when an appraisal comes in low. This does happen. It is not a great day for anyone when this happens. I will tell you that in this style of market where we have a seller's market, and sellers are able to be picky and choosy, and they are able to get more than market value for their homes. If the buyer is asking to tack the buyer's closing costs on top of that purchase price, you're getting into a dangerous situation where the appraisal may come in low. Because truly what you are asking, and this is kind of a hard concept sometimes to get. When you get it, you've got it, but I'm going to explain it a few times. If my buyer wants to offer $200,000 for that home, but they want the seller to pay $5,000 of their closing costs for them, then my buyer is going to offer $205,000 for that house and ask the seller to pay $5,000 on their behalf towards closing costs. The seller is not getting $205,000. The seller is getting $205,000 only to pass back $5,000 immediately. So the seller is getting $200,000. But if the seller has two offers to look at, and one is offering them $200,000 and the buyer will pay their own closing costs, and one is $205,000, but the seller has to pay $5,000 of closing costs on behalf of the buyer, I'm taking the $200,000 one every day of the week because the appraisal only needs to be $200,000. And the other one, the appraisal has to be $205,000. So anytime your buyer is asking for closing costs to be paid on their behalf, they are asking the seller to artificially inflate the purchase price to be able to hand money at closing to the buyer for the buyer to pay their closing costs. Now, the purpose of this is that is the only way for the buyer to roll the buyer's closing costs into their mortgage, because the buyer now gets to take a $5,000 higher mortgage principal and cover the cost of their closing costs over 30 years as part of the mortgage. That's a convenience and an accommodation for the buyer that is very normal in our industry. But when we get into this type of market, it can be dangerous for appraisals, because now you understand you're asking the appraiser to go out and look at a $200,000 house and say it's worth $205,000. For what reason? Why is it worth $205,000? In any other market where we're buying maybe slightly below market value or even at market value, the appraiser might be able to squeak out that value. But if we're already paying over what the house is worth and we're putting $5,000, $10,000 of closing costs on top of that, we are asking the appraiser for an impossible feat. Now, they don't want to tank deals. They really don't. And they are going out on a limb and assuming that this buyer is going to have this property long enough for the market value to increase over 4 or 5 years. But that's not necessarily how it's going to work. The buyer might go to sell a year later because they get transferred for work. Well, now they're what we would call underwater or upside down, where their house is not worth as much as they owe on it. Especially if they were doing an FHA loan where they didn't put much money down, they borrowed almost as much as the house is worth in a mortgage product, and they put their closing costs on top of that. Then we've got a year later, a situation where if the market went flat and houses did not increase in value, or the market actually dipped a little, and we're in a recovery period where the house is now worth a little bit less than what they paid, then that FHA borrower is now sitting on a property that they owe more for than they could sell it if they put it on the market. And when you factor in commissions and brokerage to real estate agents in order to sell that house, that is a bad situation. So these are all things you should be counseling your buyers on when they go to make a purchase. Even if they're going to use an FHA product or USDA, VHDA, VA product, and they're going to have a small down payment, and essentially they're going to owe almost as much as the house is worth, that's a conversation to have with them. This is a great mortgage product. I appreciate that you do not have to have 20 grand in the bank to be able to purchase a home. I appreciate that this mortgage product is going to let you get into a house right now where you can capitalize on a low interest rate for 30 years. That's all wonderful. But I want you to understand, buyer, that you are not going to have any equity in your home for a while. Equity in your home is the amount of value you have in the home that is over what you could sell it for. So if you could sell your house for $200,000, but your house is worth, if you could sell your house for $200,000, but you only owe $160,000 on your house, you have $40,000 of equity. So if an FHA, USDA, VA, VHDA buyer is wanting to take advantage of the low interest rates and the low deposit or down payment amount that's required for these types of mortgage products, that's great. We will always use these products. Keep in mind that you need to educate them that they can't move for 3 or 4 years. They might flatten out or even dip in value of their home over the next year or two. Just educate them on it so that they know. They're not going to be mad at you a year later when you have already told them this may be the eventuality, okay? So it's just having a deeper knowledge of what all these products are for, why we use them, and how they will affect long-term ownership on these properties, okay? I would, every day of the week, sell somebody an FHA product and get them in a house when interest rates are 2.75%. Even if they're going to have a little bit of PMI, which is private mortgage insurance, which is an additional insulating protection for the mortgage company, where the mortgage company says, hey, I think you're at higher risk, buyer, of foreclosing on this property because you don't have any skin in the game. So I'm going to make you carry this insurance policy until you have more equity in the home. Hang on, got to have a sneeze break. Sorry, y'all. So the mortgage company may say, we're going to make you carry, buyer, we're going to make you carry a private mortgage insurance policy that protects the mortgage company in case you go belly up, in case you get foreclosed on, in case you hit financial dire straits. That is money that the homeowner is going to be paying every month. It could be as much as a couple of $100 that goes to nothing. It is literally going to an insurance policy to protect the mortgage company. So that may still be worth it for a buyer today when interest rates are 2.75% or 2.5%, because you can get out of private mortgage insurance later, but taking advantage of that low interest rate may be worth doing it when really they could buy with a conventional loan a year later if they are able to save up a down payment. But I don't know what interest rates are going to be next year. So I'm not saying any of these are bad products. I'm just saying it's important to know how they all work, what their pros and cons are, okay? So if an appraisal comes in low, if you have written a contract as a buyer's agent where the mortgage product is FHA, VA, USDA, VHDA, then you have to attach the standard clauses addendum to it. The reason you're attaching the standard clauses addendum is because all of those mortgage products are going to require an appraisal contingency. We do not have an appraisal contingency in our standard purchase agreement. It is available for those types of loans I just mentioned on the standard clauses addendum. You're going to attach that document and you're going to fill out the first section of that document, which is going to require you to put in the final purchase price. When you put the purchase price in there, that language is going to state that that home must appraise for at or above that value, or the purchaser may terminate the contract and receive a refund of their earnest money deposit, because the mortgage company is not going to loan above that appraised value. Okay. Now, when that happens, let's say the appraisal comes in $5,000 low. You could renegotiate with the seller. The seller may or may not drop the price by $5,000. The buyer may be able to say, okay, I'll pay my own closing costs. I was really hoping not to, because I wanted to save some money for new flooring, but I love this house. Let's reduce the purchase price by removing my closing costs. I'll pay my own closing costs as the buyer, and now we can close on the property. So there are some things that can be done. Call me if you end up with a low appraisal. You also can research. You can ask for a copy of the appraisal. You're not, as a buyer's agent, you're never going to receive a copy of the appraisal. It is private, it's confidential. It is only provided to the buyer and the lender, but you can ask your buyer, would you give me permission to receive a copy? And then you can come through that. You can come see me. You can come see Jennifer. We're going to look over that appraisal and see if there might be a discrepancy there. Maybe there's a human error. Maybe the appraiser didn't realize that there's central air. There could be some slight mistakes in there that may bump up the value another $2,000, and that's all you need. I got lucky one time, and I got a low appraisal, and I happened to look, and between the appraisal happening and me receiving it, the house across the street closed. It had been pending. It closed. I called the listing agent and said, actually, this is one day after I got the appraisal, and it was still in pending status. I called the listing agent and said, hey, when is that thing closing? She was like, it closes Tuesday, or whatever the answer was. I was like, can you please, please, please put it in as soon as you can? Close it out in the MLS as soon as you can, because I got a low appraisal across the street, and I would love to use your house as a comp. So they did. And I was able to send that new comparative to the appraiser, who said, great. That gives me what I need to bump this up the $2,000 you need, or the $3,000 you need, whatever it was. So a fresh comparative gave that appraiser the legs they needed to be able to say, nope, I got the value now. Okay, so call me if you end up with a low appraisal. Call Jennifer. We're going to walk you through that, give you some tips, try to help you brainstorm a solution to that. Okay, do not be pissy to an appraiser. Am I clear? That will get you nowhere. Okay. And they will double down on that appraisal. And I don't blame them. I don't want to be questioned either or talked down to. Okay. So let's talk about if you're doing a conventional loan, you're the buyer's agent, and you are writing a contract for a conventional loan. You have to remember that there is no appraisal contingency with conventional loans. If you write a purchase contract as a buyer's agent and you use conventional mortgage product, you have to write in the appraisal language if your buyer wants to. You may say to the buyer, we're buying this $200,000 house for $215,000 because we got bid up. Are you okay with $215,000? What if the appraisal comes in at $200,000? Do you, buyer, have an extra $15,000 to bring to the table to still be able to move to closing? And if they say, yes, this is next door to my mother, I want to live next door to her, I will do what it takes, and I will come up with the $15,000 in cash to be able to cover that appraisal shortfall. Now, most of the time, the buyer's going to go, no, I don't have $15,000 extra dollars in my bank account. Well, guess what? Me neither. So you have to write in appraisal contingency into the contract. Now, I've tried to make it easy for you. If you go to the additional financing terms on our purchase agreement, there is a pretty little scroll of paper that's just hovering right above those lines. Click on that. Switch to broker clauses. I have an appraisal contingency language clause already written for you, and you just have to hit the insert button. It's going to put it right into the additional financing terms for you. Go to our YouTube channel. Look for my little tutorial videos I have that are like 2-3 minutes long. It is literally me on mute walking you through, sharing my screen and walking you through how to access those broker clauses and how to insert them into your additional financing terms. Okay. So when you do that and you say, okay, we used an escalation clause, we're purchasing this house $15,000 above list price. We're going to put in some language that says seller and purchaser agrees that this home must appraise for at or above the purchase price, or the purchaser may terminate the contract, receive a full refund of earnest money deposit, and not be deemed in default. That's because if the appraisal comes in low and the buyer says, I'm not buying it for above appraised value, you now have a termination right. If you don't put that language in a purchase agreement that has a conventional loan and you receive a low appraisal, your buyer is stuck and they will be in breach of contract if they do not have the funds to settle. The clause directly below additional financing terms says purchaser will bring the remainder of the money to closing as a cashier's check or cash. That is the clause that's going to bite your buyer in the rear end. If they're using a conventional loan, you have not written in appraisal language and the appraisal comes in low, because that seller is going to say, too bad. Too bad. You said you'd buy it for $215. And I can't argue with that seller. They accepted a contract for $215. You told them you would give them $215. So the appraisal has some bearing, but they picked you because you said you would buy the house at $215. Market value and appraised value are two different things. Anytime we see a boom in real estate value, we run into this problem. So anytime the market value is pushed to the limits and we have multiple offers and we are in a true seller's market, which heaven help us, we've been in a true seller's market now for like 18 months, 24 months. It's getting real tired. Check on your fellow realtors. We are all tired. So anytime we're in that style of market, we run into this problem. So I'm not going to beat a dead horse. We're going to move on to the next talking point. But if you have follow-up questions about this is kind of thick stuff. Feel free to call me. Feel free to shoot us an email and ask us some questions. Got an interesting question from one of our agents this week where she said, I'm representing a buyer. We're putting an offer on some land. My buyer's paying cash and they want me to write in an appraisal contingency. They want to have an appraisal. Well, that's weird. Usually when you're buying cash, you're just buying it at the market value. You're buying it whatever you're buying it for. The appraisal is generally to protect the mortgage company, the lender, but it is also to protect the buyer. It's to protect buyers from getting taken advantage of in a market like this, okay? I'll argue the seller's not taking advantage of anybody. You don't have to buy their house. You don't have to buy their land. If somebody wants to buy it above market value, fine. We're all adults here. She was asking me, is that weird? I said, yes, it's a little bit weird. It's unusual. Okay. But there's no reason why you couldn't have an appraisal contingency on a cash contract. Maybe you want that. Maybe you don't. I would say it's odd enough. I would walk through that thought process with my buyer and say, talk to me about why we want to do that. And if they say something like, I just want to make sure it's fairly priced, fine, let's do that. They may be functioning under the belief that they have to have an appraisal. Now, I would never tell somebody not to have an appraisal, but I'm at least going to walk through the thought process to find out why they want to have one. I do believe it could be a good protection for the buyer. Now, if there are multiple competing offers for the property, I will also make sure my buyer understands that that may be a detriment to them winning the bid. But I'm never going to make them do anything they don't want to do or give up some sort of contingency they want in there. But I am at least going to educate them on it. Okay, let's open it up to questions. I knew one talking point, appraisals, would take me all the way through this session, but I'm sure you have questions. So I'm going to pause for a minute and you guys jump in. What you got?
I have a question.
Yes. Hi, Daniela.
Hi. Do you know why are the appraisals so much more expensive on mobile homes than regular residential homes?
I have one thought on that. I don't truly know the answer. So full disclosure, I'm guessing here. But mobile homes, unless you're doing conventional, mobile homes also require what's called a structural report, an FHA structural report. And so if you're doing FHA, USDA, VA, VHDA on a mobile home, first of all, just to educate, since this is a new agent training, it has to be real estate. The mobile home has to be real estate. And in order to be real estate instead of personal property, it must be on a permanent foundation. Mobile homes could be personal property, and they have a title just like a car. And the DMV holds those titles and issues those titles. So a mobile home may need to be converted to real estate with a permanent foundation and a process by which the title is surrendered, and instead it is re-registered as actual real estate with the municipality. So part of the FHA process when purchasing mobile homes is a structural report, because they want to verify that it does have a proper foundation, that it is a permanent foundation that is that meets the criteria for the permanent foundation for mobile homes. That's my best guess, Daniela, that would be an extra expense, but I certainly don't mind reaching out. I've actually got a double wide under contract right now with an FHA loan on the buyer's side. So I certainly don't mind asking and finding out.
Ashley?
Yes, Samantha.
I have a gentleman that will go out. It's like $120, but when I list a mobile home, I always have Joe go out, and that's what he does for a living. And he goes out and he makes sure the structure and everything is there, and then he'll give me a letter of completion that it will pass FHA.
Great. That is
so I do that before.
Fantastic pre-listing task to get done. Because I'll tell you, this contract I got, apparently those structural reports can be used forever, really, because the buyer's agent reached out to me and said, hey, did your sellers buy it with an FHA loan? Because if so, could they put their hands on their structural report and provide that to us? But my sellers did not. They bought it from the proceeds of their home they sold. So they did not use an FHA loan. So a structural report had never been done. So now we're going through the process of having a structural report done. That is great. Yes. Would you
want me to send you the information?
Yes. Give me Joe's information. If you'll email it.
He's an engineer. He's a retired engineer, but that's all he does right now.
Great. If you'd email that to me, Samantha, I'd be very grateful. Thank you.
You're so welcome.
Anybody have any other questions about appraisals? I know I probably just blew the tops of your heads off with too much information today. So sorry.
And they won't do a conventional loan on a mobile home.
They won't do a conventional loan?
On a mobile home.
I see.
A single wide.
A single wide. Okay. Yeah. I was not aware of that. Thank you, Samantha.
Found that out the hard way.
That's how we find out everything. That's why I try to tell all of y'all so that you don't have to find it out the hard way. Anybody have any other questions? Otherwise, we'll move on to our Get Business Quick idea. Anybody? Okay. So that's probably because I just turned all your brains into oatmeal. So sorry. And if you have questions later, just reach out to me and ask. I'm delighted to answer any questions. So my Get Business Quick idea is to follow and emulate a social media real estate personality. Go outside of our area. Don't pick a local real estate personality. And the nice and bad thing about social media, as y'all already know, like if I click on, if I search for extension ladders, because I need to purchase one to clean out my gutters, My sponsored ads for the next 3 months are going to be extension ladders. I wish there was a button where I could say, I already bought one. Show me something else, but there isn't. So the nice thing is if you start following some social media personalities in real estate on any of the social media platforms, it's going to start recommending some others that are similar. Start watching. How are they marketing themselves? How are they framing themselves? How are they branding themselves? And just try out some of what they're doing. You know, if every Thursday they're going to a coffee shop, a different coffee shop, and talking about the coffee shop, try it. Why not? Some of that following is how you find out that there are resources on these business pages that you didn't even know existed. You know, on Instagram, you might not have realized you can have sections of Instagram where you can provide resources, recommendations, all sorts of stuff. So you can have a more robust business page that people actually go to for resources instead of it just being, here's a picture of me with my coffee. Here's a picture of a cute dog. You know, don't reinvent the wheel. Just go check out what other people are doing and try to then look and see how does that look different from yours. Okay. There's a reason they probably have 10,000 followers. Okay. All right. That's all I have for today. You guys let me know what else you've got.